Ladies and gentlemen, we just got earnings out of one of my favorite real estate investment trusts of all time, of course, being Riocan, that gave some very insightful knowledge into the landscape of the Toronto real estate market during this recessionary period. When we scroll around on Google, just taking a look at what's going on with Toronto real estate, we're seeing all these articles like Toronto housing market is facing one of its deepest declines of the past 50 years. We're seeing things like patches of grass still get listed for $1.1 million. And I think this is just giving some of that fruitful insight into the really hard to wrap your head around supply and demand metrics of the city of Toronto, as most of the demand has shifted over to the rental market, driving up rental prices to absurd levels that again really affects the bottom line of these REITs. So we're seeing net asset values decrease, but rental revenue increase. And what does this say for a company like Riocan? Well, let's find out. Now, first and foremost, Riocan is a stock that many of us became very appealed to in the midst of the 2020 crash. You kind of got to framework it as a lot of us were gobbling it up down here. We can see that my average buy price on Riocan is about $17 a share, up 20% just from a cap gain perspective. But again, from a dividend perspective, they did cut it and then they started raising it. We're not back to the recent dividend highs. So there's some confusion in there for those looking for more dividend aristocrat based REITs, but I still love my Riocan being basically Canada's largest pure play REIT to Toronto, in my humble opinion, because we can see 52.2% of their entire real estate exposure is in Toronto. So whatever really happens there is going to dictate the entire company, in my opinion. But again, great Canadian exposure across the board. And taking a look, for those of you that aren't aware, Riocan right now is trying to expand into the residential sector. They just brought on a couple hundred units, but expected to bring on over 1,000 plus units in the next year or two. But we can see 19.7% of their entire exposed rental income is coming from grocery, pharmacy, and liquor stores, which is incredible. So your Walmart, your Shoppers Drug Marts, your LCBOs, and then you got specialty retailer, essential personal services and things that were much more concerning during the pandemic, like movie theaters that still make up almost 4% of their entire portfolio. Luckily, those are having a comeback after they had to reduce some of their portfolio, as we saw basically during the pandemic, the 2020 period. We saw their actual their occupancy drop to 95.7%, whereas today it's back to those post-pandemic levels of about 97.2%. It looks like they like to be between 97 and 98%, which is again really robust, right? But taking a look at the earnings that at a glance look relatively concerning off the hop, because their net income dropped to 78.5 million from 2021, this same quarter period of 145.3 million. So what is causing that? Even though we're seeing basically the funds from operation actually be higher than they were from this time last year. So let's talk about the net operating income, because this is where things kind of get a little confusing. So trying to figure that out based off this little article here, they kind of highlight it and they mentioned this in the earnings call. But basically, Riocan says same property net operating income growth was about 6.2%, which helped the trust in the second quarter, in addition to the higher residential NOI and residential inventory gains. But this was offset by a net loss related to fair value of investment properties of 42.3 million compared to 22.9 million fair value gain in the same period last year, because real estate was exploding. Last year it was easy to see fair value gains go up. These don't actually represent the bottom line of the revenue. It's just the value of these properties, and that the fair value loss that they took here was basically from their malls. And I want to talk about the retail market and those malls and why there's actually huge potential value into them moving into the future. I'm going to come back to this, but first and foremost, just kind of keeping on the balance sheet perspective, what I always want to pay attention to with REITs is their rental revenue. The reason this is so important is it's basically the underlying health meter of every real estate investment trust. Presuming that's going up over time, we're usually sitting in a pretty good spot, because we can see the total revenue from an IFRS basis was 308 million versus this time last year, which was 297 million. So we are seeing an incremental increase here, which is what exactly we need to see to be in a good, healthy position. Now, taking a look, a lot of the future growth, as mentioned, is going to be coming from the kind of condo market and just residential units. So we can see there's about 1.7 million square feet coming online between the end of this year and next year, which by the end of this should equate to about 34.5 million of net operating income, showing a bottom line increase probably of around 8 to 10%. So we are getting some growth metrics coming into the future, which will hopefully correlate to a re-increasing dividend. But keep in mind, they are currently using the extra cash flow to buy shares back off the table. So that is good from a shareholder perspective, right? We all get a little bit bit more ownership in the REIT. Now, circling back to by far the most interesting thing to me on this earnings call, considering this is purely a retail REIT, and we know most of the demand in the residential markets for housing has shifted over to basically the rental market. But when we're talking about to retail specifically in malls, the CEO mentioned that they can't actually build new malls anywhere in Toronto and make it feasible from the rental standpoint. And this is leading all new demand for basically people wanting to get into the retail market, specifically store locations. They have to go to the existing places that already exist. And that's why we're seeing demand for retail and this cost of square footage actually going up with a company like Riocan, or a REIT like Riocan, because we're sitting about $20.39 per square foot, which is going up quarter or year over year and really quarter over quarter. And it's really intriguing to me because they say here new retail only represents 1% of existing supply over the last 5 years. And again, they're saying that unless you already own the land, going back to the idea that a patch of grass is going to cost you $1 million in Toronto, you can't really buy somewhere to build a new retail place to make enough net operating income or rental income off of that property to justify building it. So you really are stuck with these few conglomerates and these few massive retail REITs that give you that kind of exposure. So they are getting some cushioning here just because there's no new competition. There just won't be in the coming future. So this is what I found probably the most intriguing and probably one of the cushionary factors that, again, if there's nowhere else to go, Riocan, Smart Centers, these companies that have the full exposure to these shopping centers are the ones that are going to basically dominate it. They're like conglomerates within their own game here, and they're expanding on them because they own the properties. So here's a quick little highlight. I took some segments of the CEO himself, just kind of talking about this recessionary period. So just take a quick listen.
First, I'll talk about the recessionary environment, specifically the viability of retail during a prolonged economic slowdown, if in fact that arises. 86% of Riocan's tenants are categorized as strong and stable. These businesses have stable rent-paying ability, strong covenants, and reliable foot traffic. They provide the day-to-day essentials consumers require in any economic climate. I'll pause here for a moment to reflect on our performance in Alberta over the last 10 years. Now, I use our performance in Alberta as a logical barometer, as our portfolio composition in that province mirrors that of our national portfolio. The Alberta market has been in the throes of a resource-based economic slowdown for the better part of a decade. And within those 10 years, the operational metrics for our assets in Alberta were equal to or better than our national portfolio. In as much as anyone can draw any conclusions in this uncertain environment, we feel that our consistent performance in Alberta in the face of an economic downturn is indicative of our portfolio's resilience and viability in any market conditions. The best way to summarize our operating results is to say it was a tremendously successful quarter, and we're achieving results that are in line with where we stood before COVID. Occupancy is at 97.2%, bolstered by our retail occupancy, which is now at 97.6%. FFO per unit is 7% higher than it was in this quarter in 2021. Leasing results, which are, I would say, the purest indicator of the overall health of a commercial portfolio, well, they're very strong. Blended leasing spreads were 10.5% for the quarter. Same property NOI grew by 6.2%. Tenant retention was over 93%. Now, this number tends to bounce around a little. While it tends to bounce around a little, the prevailing trend confirms that tenants value the space and the service that Riocan provides, and they really don't like to give it up. The 11.2% spread achieved on renewal rents in the quarter highlights how aggressively tenants are pushing to maintain existing space. On average, the people shopping at Riocan's properties have a household income of $129,000 and come from a population base of over 206,000 people within a 5-kilometer radius of our centers. We also invested in our physical properties, technology, ESG, and the dynamic team here at Riocan. Those improvements and investments are now paying significant dividends. Since 2020, we've delivered a combined total of 1.1 million square feet of successful developments, mainly in Toronto. That number is expected to increase to 2.5 million square feet of new development completions by the end of 2023, including our iconic Toronto development, The Well. We now have 2,005 residential rental units in the portfolio, with another 1,134 under construction. Demand for these units has continued to demonstrate the desirability of the Riocan living offering.
So on that note, folks, I think Riocan is an exceptional fair valued buying opportunity here, and I'm really going to be paying attention to Canadian apartment property REITs earnings, which is going to give full insight into the real residential market, especially considering how much we're seeing rents go up. We're going to be taking a look at Northwest Health Properties and, of course, some of the logistics REITs with Granite Real Estate Investment Trust, perhaps Dream Industrial as well. And if that is a conversation you can appreciate, let me know what you think in that comment section below, and consider subscribing for those updates. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.